watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Ricus Reeders, PSG Hole and One, Ruimsig, and Rowan Williams from Nitrogen Fund Managers. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV, #Stockwatch. Gents, appreciate the time. Rowan, let's start with you. Let's start with the Sibanye-Stillwater deal they announced this morning. What's it? It's a little under $100 million, buying a US metal recycling business. I ran some of the numbers. I mean, in terms of copper, they don't really have. In terms of silver, it adds about 50%, gold 5%, PGMs not a heck of a lot. Your thought, Rowan, on the deal in specific, but Sibanye-Stillwater more broadly, because they got gold running, now they got PGMs running.
Yeah, so it's been a remarkable turnaround story. I guess a few months ago things were looking significantly different, and maybe what it shows that Sibanye is back on sort of getting its mojo and the acquisition path. I mean, it has made a number of acquisitions, but I guess some of the results in the short term have been mixed. But just points to renewed confidence, obviously looking to diversify their resource base somewhat in terms of adding copper, and I think sort of broadly positive, and it does look like they are just feeling more confident. So I think part of it is that signal that they're confident about the metals and their future and their balance sheet, that they're able to pull off a transaction like this. So I think interesting and overall positive for the outlook.
Ricus, your take on it? It's one of the few which is diversified into the two precious. Most are either single commodity or they're off into other different commodities. Your take on the deal in Sibanye-Stillwater? It's had as Rowan says, I mean, it's had a bit of a flyer in the last couple of months with PGMs going its way.
Yeah, certainly that's helped the price. It's helped their cash flow, which is why they, as Rowan said, I think they feel confident in doing this kind of deal. And what's interesting is just taking a look at what management said, and I'm very glad they didn't go and buy a mine. But what they're really buying, I think, is technology. I mean, the company they're buying has been in existence for well over 50 years, I think, so they know what they're doing. So they're buying expertise, and that ties in nicely with, for example, their lithium project in Norway. So it's a diversification not only across different metals, but also the ability to add some benefit to those metals that they actually mine. So I think it's a nice long-term strategy.
Yeah, I take it, and it is. It's buying those skills perhaps as much as anything else. Ricus, let's stay with you. We had a Valterra update on Friday. A question came through over the weekend. Horror update. Should I be worried? It's more historic. Ricus, it's floods in February. It's a PGM price which only moved sort of late in the period for the update. The Valterra update concerns, and is that a good place if you're looking for PGM exposure?
Yeah, as far as the update's concerned, it's history. I mean, it's got nothing to do with the operational capability of Valterra. There was a lot of once-off costs that they had to do in order to be on their own. So looking forward, not only Valterra but the rest of the platinum sector. We've just spoken about Sibanye. These guys are all in terror at the moment. It's directly tied to the metals that they produce. So as long as everybody keeps their costs in control and they don't go into adventurous buying sprees, buying overvalued assets. I don't think Sibanye has done that, by the way. While the PGMs are going up, these counter share prices will go up, and there's insane technical targets on all of these things, and we know how exuberant the market can go. But so it's nice if you've got it and ride the upside. Just be aware that, as so many times in history, it's going to turn at some point, and then you have to be very sure that you don't hold it on the downside as well.
Yeah, it's that managing. Ricus, let's stay with you a moment. Platinum and palladium, platinum particularly, what that chart is, 10, 11-year highs, palladium a little bit lagger. I mean, do the charts look convincing to you? I mean, they're almost vertical in the last little while, particularly in the platinum space, having broken a couple of layers of resistance.
Yeah, it's almost vertical, but then again, if you take a look at how they came down, that was not quite as vertical, but I mean that was quite severe. So guys that look at charts, and I include myself in that, you take a look at this and say this is significant. You might have pullbacks during this one, but in the case of platinum, it can still go higher. It's I don't know why it would do that, what the impetus would be, but the fact is that price momentum is positive, and don't be too worried if for no fundamental reason we get sharp pullbacks, whether it be rumors about the news Fed or whatever. But I think both the fundamentals are in place to have some underpin to this rally.
Rowan, how are you looking at the PGMs? I mean, certainly the metals have moved. It's looking convincing. The stocks have followed to a fair degree. How are you and your colleagues looking at the Platinum Group metal miners?
Yeah, so I mean, it's a conundrum, because if you haven't had them in your portfolio, you are getting left behind. So traditionally, I mean, we look like more sort of fundamental industrial businesses. And they're extremely volatile. So what we have been looking for is where there's sort of been optionality potentially on price upside. And African Rainbow Minerals was one share that we like, where they have a number of platinum projects, but weren't really being priced into the portfolio. And in that way, sort of, I think if you get optionality to the volatilities to platinum, obviously that can have significant value, and without sort of getting direct exposure. The underlying shares and the sort of movement in the platinum, as Ricus was saying, it's sort of not entirely clear what's driving it. It seems that the gold price and some accumulation in terms of a precious metal, as opposed to sort of for its industrial uses, is driving demand, ETF demand. China has been stockpiling, some indication of a potential shortfall. And so that sort of squeezes the market higher, but it can turn quite quickly. So we would be quite cautious overall. I mean, they've had an incredible run. It's interesting, those shares with the sort of weaker balance sheets, including Valterra now, tend to sort of run more because they're more marginal. So that's also sort of increased risk and increased upside. But we're very cautious, and as I say, looking for something with some optionality. So African Rainbow is how we would play it for now.
Yeah, and I forgot, of course, with the separation between Valterra and Anglo. Anglo took all the money. Valterra took the platinum, Anglo took the money. Rowan, next day with you, question coming through. Thinking about local clothing retailers, surely they're starting to look cheap at this point, some more than others. Rowan, what are your thoughts on the local clothing retailers?
Yeah, so the recent performance has actually been quite disappointing, and that looks like it's off the back of sort of improving consumer environment. We've seen a few rate cuts. I think we're expecting another one sort of in the short term. The rand has strengthened quite considerably, which means their gross margins tend to do a little bit better. Obviously, the strong rand also helps the petrol price. And so it looks like it's been a cold winter, which creates seasonality and demand there. It was not so cold last year. So overall, I think they are looking quite positive. It seems that foreign investors have got lukewarm on the sort of consumer sector in South Africa. And I mean, the money's going into the resi and the resource counters like we've just discussed. So actually, I agree. I think it is an opportunity. Some of the sort of near-term results have been a little bit lackluster, and maybe they'd run a bit ahead of themselves, but they've come off quite considerably. So Foschini's, Woolworths, Truworths, all looking reasonably priced here, and I think there could be decent performance, Mr. Price, as well.
Ricus, if my memory serves, you've been a fan of Pepkor for some time. Would it still be Pep for you?
It still is. They of the bunch, they held up the best during, a 20-25% drop in some of the other share prices. For obvious reasons, they are a bit more defensive on the cash side of things. I've mentioned the fact that I like the stuff that they're doing in finance. So while the trend is not telling me elsewhere, it still is my preferred counter. But yeah, things like Fashini and Mr. Price have been sold off quite dramatically. And if we're sitting with a kinder consumer environment, there's potential for those to recover from what really has been quite a bit of a sell-off.
Ricus, let's stay with you. Question coming from We Buy Cars. I read an article over the weekend that suggested cheap Chinese cars could see more new cars rather than second-hand cars buying. I got it in the unbundling. I've done incredibly well. Should I be perhaps taking some or all profits? Ricus, your thoughts on We Buy Cars? Certainly it's been a spectacular listing since it came on, about a year ago?
Yes, and they were breaking to new highs. They've taken a bit of a rest over the past week or so, but not surprisingly so. Because of the breakout to new highs, I'm still very comfortable with it, even at current valuations. And as a trading platform, yeah, you might see a softer second-hand market because of Chinese imports, but I don't think, considering the scope they have and the kind of margins they are trading at, that it's going to make too much of a difference. So yeah, just in general, still pretty positive. But as I said, I won't be rushing in right now. Mm-hmm. But certainly, any other further price weakness, it's back on the buying list.
Rowan, your thought on We Buy Cars? I mean, maybe the Chinese is just not buying a luxury German sedan and you're shopping down. Your thought? It certainly has been, it's up some threefold since the unbundling of last year.
Yeah, so certainly the valuation's a lot keener than it was. I think it was very attractive on listing. That's partly, I guess, because of the necessary unbundling out of transaction capital at the time. So, yeah, I think if you've done it, you've done incredibly well. To me, it looks pretty full here in terms of the growth prospects. I wouldn't be overly concerned in terms of those Chinese imports. So they did indicate at their recent results announcement that they weren't seeing a softening of demand. I think maybe that is in the new car market where it's impacting sort of other brands to a greater extent in some of the dealerships there if they don't have those brands. So that would be more of a concern for me. But I would look at the valuation of We Buy Cars here relative to the growth prospects. And it is a great business and has good growth prospects, but looks fairly full here. So maybe rotating some of it out into something that's more attractively valued may make sense.
Yeah, and certainly you've done spectacularly well in a market that's seen a lot of good value, but that's been one of them. Question coming through, simple question, ask your experts, that would be you two, ASL, ASMO or TSMC. Both have results out, both nice. ASMO didn't like the future prospects. Ricus, would either of those be on your list?
TSMC, except for China. I mean, it's not a zero probability or possibility that China invades Taiwan, and then you've got a problem. But as long as that doesn't happen, I would probably be. I don't think I would choose between the two. I would have both, as both the one that creates the machine that manufactures whatever Taiwan Semiconductor does. So in all else being equal, which it never is, considering, as I said, the geographic risk you've got with Taiwan Semiconductor and by definition ASML as well. But yeah, I would have both at current prices.
Rowan, ASML or TSMC, maybe it is a bit of both for the sort of the AI boom or just the chip boom. I mean, everything's got chips in it these days.
Yeah. So, yeah, I think TSMC will be benefiting to a greater extent in terms of the AI chip boom demand as opposed to ASML. So I think if you still like, the prospects, and they do look incredible for AI and the continued demand there, I think TMC will benefit to a greater extent. And so, that would be my pick out of the two if I had to choose.
Rowan, let's stay with you. Question coming through about BHP Group. Thoughts on the Friday update? Looked strong, particularly iron ore and copper. And Rowan, that's what you want your miners to do, is set record productions when prices are looking good, or the iron ore prices under pressure. Thoughts on BHP Group and the Friday update?
Yeah, so it's a quality operation, and I think they largely met the production guidance, which the market was overall happy with. The one large project, that was sort of, the big negative, where that's had overruns in terms of cost and time delays. So that offsets, I think, the positivity to some extent. But, given the exposure to copper, and it looks like the iron ore price is recovering from lows, that it looks very solid. We've seen the resource sector in general being in high demand, and sort of this kind of theme of increased green metal demand starting to play out now in the market and in the share prices. It looks like it sort of had a little bit of a sort of soft period of performance, and it's a reasonable time to get in to play that resource boom and continue demand. So it overall looks quite nice.
Ricus, what's your take, BHP Group?
Yeah, I thought they were decent results. All they're waiting for is the metals to start working in their favour, which I agree with Rowan. It seems to be starting to do that, even with iron ore, and specifically the noises coming out of China, as far as supporting that side of their economy is concerned, closing down non-efficient plants, getting, basically giving support to that sector. That all helps as far as the demand for iron, gold to a certain extent, copper definitely is concerned, and by default then your big resource players, Anglo, Billiton, are starting to look attractive at these levels. Again, I would look back at the Billiton update. They've done what they can do well. If metals turns in their favour, hopefully they will keep on doing that, and that's going to flow down to the bottom line, which means that they're quite attractive price-wise at these levels.
Let's stay with you for a moment, Ricus. Question coming through. I'd hold Pick and Pay. My logic was that I got the Boxer or the cash, and it was trading at a discount to those two. But it's been disappointing. Should I just hold Boxer instead? Ricus, would you be holding Pick and Pay or Boxer? And I know this is allied to your stock pick, perhaps neither. Yeah,
I mean, Boxer is interesting. If I'm holding Pick and Pay just because there's a discount, you're getting Boxer for free or whatever, you're still holding Pick and Pay. And I'm not in favour of holding companies which I don't like the operational management of. I mean, there's a lot to be done to turn that business around, and I always say I don't want to be part of that process. I'd rather go and put it in a place where I know it's working and where it's going to continue on working. So Boxer as an optionality. I think Pick and Pay is just too 50-50 for me to say, well, go and take a bet that they're actually going to turn the place around.
Yeah, Rowan, your thoughts? The going in sort of on the underlying asset, or would you rather pick one of them, or perhaps neither of them?
Yeah, so we do like situations where we consider there to be some free optionality. I think in terms of the current spread and valuations, if you buy Pick and Pay, I mean, you're certainly getting Boxer, so you're getting the fundamental performance of that business. And just given the balance sheet, I think the progress made to date inside Pick and Pay in terms of that turnaround, what I think you're going to see is a smaller profitable business. The clothing is already a nice profitable business inside Pick and Pay. And the supermarket business can still do well. It is still a strong brand. They have some good sites. And so sort of stemming the losses, cutting the losers, and then you get a business that owns or controlling interest in Boxer, as well as a profitable grocery retailer that looks quite interesting to us. So at this point, we would prefer, Pick n Pay over Boxer. We like the Boxer story, and that's partly why we don't Pick n Pay as well.
I get your point in it. Rowan, a question coming through. I'm looking for some REITs. I've held an ETF last year. It's been great. I'm looking to perhaps get into an individual local REIT. Is there one that the panel prefers? Rowan, have you got a preferred REIT on the local market?
Sure, yeah. I mean, it's interesting. Some of them have done quite well. I guess what you're looking for is either you're going to go for it as a South Africa-focused REIT, or you could go for something that's listed on the JSE, but maybe has more exposure to Eastern Europe, or something that has both. So I think we quite like Growthpoint at this point. It is more South Africa-focused. They're doing very good things in their portfolio. It's quite a safe bet. You've got bond rates, yields coming down, probably interest rates coming down. They've got good exposure to the waterfront, which I think has a lot of exciting plans in the year ahead. It's probably the best property assets in the whole of South Africa. So you're getting all of that and probably improving fundamentals overall. It's a fairly safe bet. So that would be our preferred pick.
Ricus, a REIT for you?
Yeah, Growthpoint's nice. The other side I prefer Resilient, which I've got in my own portfolio, and Vukile, which seems to be doing nice things on the Iberian subcontinent.
A question came through. I hold Mass PLC shares. I don't want to sell to Hyprop for their cheeky offer, and that is in inverted commas. Ricus, I read that update. My understanding is the offer was cheeky. You don't have to sell. This is voluntary. You can say, thanks, but I'm going to keep my Mass PLCs.
Yes. I've been following that story from the sidelines and will continue to do so. I really don't know. It's there's a mess of core productions going on and all sorts of various stories and whatever. And as with companies that I'm not sure about the ability of management turning stuff around, I also don't hold things where there's a cloud of infighting and lawyers getting rich, I'm concerned.
Yeah, there certainly are some lawyers doing very well on that, absolutely. Question coming through around Microsoft. Is Microsoft worth a look? It was boring forever and a day, but had a really good decade since then. Ricus, before we go to stock picks, Microsoft for you?
Looks solid. I mean, it might be a little bit expensive, 35p, specifically if you compare it to something like Google, which is sitting at 20, but... as far as the dominance of Microsoft is concerned, I think at this moment, I won't say at any price, but at current prices, it certainly is worth a hold.
Let's go to some stock picks. We've got an extra minute there. Rowan, you're going with Coronation.
Yeah, so I mean, we were chatting earlier about some of the high flyers on the JSE, including the platinum sector. So what we saw was Coronation came out with their latest AUM update, and in the last quarter up to the end of June, their assets under management went up 9%. So that gives you an idea of the underlying performance that they're seeing as a result of exposure to some of these shares. Naspers Process also doing incredibly well. So, and that will definitely feed through to the bottom line in earnings. A lot of the revenue is obviously driven by their AUM base, and as that's growing, the earnings will grow quite nicely. So it's sort of a leverage play on the JSE. The share price is cheap, sub 10p with a very high dividend yield. It's been 10-11%. The share has moved up a little bit since that AUM update, but I think it still has a lot of potential. We're quite bullish overall, still on the JSE, and some momentum continuing there. And this is a nice leverage way to play it. If they do perform well, they're also going to get some performance fees. That'll be a kicker. I think that's just sort of extra kicker, but without that, it's still an attractive investment at these levels.
Yeah, I mean, 9% up in revenue, and your cost base stays the same pretty much. I mean, maybe some bonuses if there's some performance fees, but absolutely.
Exactly.
Ricus, Shoprite, I was actually having a look at this one over the weekend, and it is looking quite juicy. Your pick today?
Yeah, it's in the background of possibly lower interest rates and inflation. Your consumer might be getting some relief. If you take a look at Shoprite's share price is exactly the same as it was 5 years ago, plus minus. Considering their consistent volume growth, their consistent margin growth, basically the quality of the management, and at current valuations, at least a 15% upside as far as I'm concerned, as long as that whole sector keeps on benefiting, as I've said, from more benign economic circumstances and with limited downside. So technically it doesn't look great, but it looks good enough if you are looking for an entry into your consumer side of things. I don't think Shoprite, as the leading company in that sector, is at a terrible price to actually start buying some.
Yeah, and certainly, I mean, they are the giants in the room in many sense, and they sort of flex that muscle all the time. That's all for Stockwatch today. Thanks to our guests, Ricus Reeders, PSG Hole in One, Ruimsig going with Shoprite, Rowan Williams, Nitrogen Fund Managers going with Coronation. Up next, the close. Stay watching.